Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, the world is in a very different place than the last time we had Trillions, and we felt like we needed to bring everyone up to speed on sort of the big macro implications of this war in Ukraine and the role of commodities and what's happening in the commodities market, because there's a lot of turmoil and commodities are basically part of the thing that everybody's watching.
Yeah, we plan to do this episode really because commodities are the new shiny objects. I mean, if you look at the commodities category, which has been really bad for like a decade, it's now the hot spot. Really, it's green all over, no matter what commodity you pick pretty much. And we were going to do it because commodities are up because of inflation fears, where they were. Now you have geopolitics. So we've got two major catalysts here that are creating potentially a really attractive category, and investors are starting to put in money, and the commodities ETFs have grown by about 50% over the past 14 months in organic growth. So there's a lot of trapdoors, a lot of rated R products in here, places to, that you don't know what you're doing. It can be tricky. So we really need to be careful when we go over a category like this.
So to help us make sense of everything, Mike McGlone, commodity strategist with Bloomberg Intelligence, is going to help us understand the field. This time on Trillions, can the boom in commodities last? Mike, welcome to Trillions.
Thanks for having me.
So, Mike, before you were at Bloomberg, you actually were in the ETF world. So let's just start there. What did you do before you were a commodity strategist?
I did. I like to say it just took me 30 years to get to Bloomberg, but Eric and I met on a panel. I was the head of research at ETF Securities, which is now WisdomTree. And I remember us discussing precious metals and stuff like that. And so we've been, it's been, how long is that, Eric? About 8-9 years now?
It was probably about 10 years ago. Can I just explain what Mike did on this panel? I think we were in Austin, Texas or Dallas in this like cool art bar. We were using these unique venues to do presentations on ETFs and panel discussions. Anyway, Mike actually brought like physical gold coins or silver coins, and he held them up. And I was like, I told him after, I'm like, props. I like that. That's good. I gotta use some props in my thing too, because these panels can be so boring. So anything that you can do to spice them up, I like as a presenter. And that's how I first met Mike. And then that night, or later that day, I saw him in the line at the airport waiting for bags. And that's how we started talking, and we met.
That's how we became friends. And man, I remember I had one of those silver dollars. If I had just given you the equivalent, or had the equivalent amount of Bitcoin, I would have been much better off. So much for the physical commodities anymore. I guess they're coming back a little.
Also worth mentioning that you cover cryptocurrencies for Bloomberg Intelligence, which I'm sure we'll talk about. But
Mike has gone full crypto. We talk half crypto. Yeah. I think he's probably 90%.
Yeah. So, Mike, let's start in a non-crypto space. Let's talk about Ukraine. Commodities has been just on this tear. There's, the word super cycle was dropped many times last year. So where are we at in that super cycle, and sort of bring us up to speed on inflation and what you're seeing in Ukraine?
I think the most important thing for investors to realize here is allocating or some partial allocations to commodities has worked really well as a diversifier. And that's been the investors who did that early on are reaping the benefits, at least having that hedge. Because the Bloomberg Commodity Index up almost 19% on the year, crude oil up almost 30% as of the beginning of March, and stock market down, NASDAQ down 13%. They're doing what they're supposed to do. But the key thing that's happened is the market's priced for a significant amount of demand, about a supply shock out of the Russia invasion of Ukraine. And I actually think it's going to be the opposite. I think it's going to be more of a demand destruction event like happened in 2008. And I'll bring those parallels in there. But one thing we need to point out is this will be a absolute boom for North American commodity producers. Now, we can get in that later, and a lot of our audience will be interested in some of those producers, because right now, crude oil is just the first time WTI really sustained above $100 a barrel. The first time it did that was in 2008. right about this time of year. We'll dig into that. The parallels are uncanny. It's very scary. But we're basically almost triple the cost of U.S. production shale. Where if producers can hedge out 2 to 3 years based on the curve, and you can roll down that curve when you're investing in those commodities, and they can double their cost of production in terms of a price in the screen. It's happening in all the grains and everything. So this is an absolute boom for those producers. It's a question of sustainability. My fear is this war will trigger a global recession, which is overdue, and the whole thing will tumble down like in 2008.
Well, okay, that's a lot of like in the know macro talk. Right? Let's just take a big step back and talk oil, okay? XLE is a popular ETF people use. I believe last time I looked, it's up like 90% in the past year. This wasn't supposed to happen. I remember some people were like, oil is over. This is a green revolution. This will never happen. Just explain to us why oil in particular is up so much in the past 12 months if we're supposed to be like over oil.
Well, first of all, the bottom line, the foundation for oil going up to $100 a barrel was it went down to negative 40 back in April 2020. That shut off a lot of production. And from that, we came out with this almost unprecedented discipline from OPEC. Now we're returning to a demand environment and the supply is not there, OPEC discipline. But if the lessons of oil is a good example, the higher price cure should kick in and we should go back to where we were before. So let's point out right now, the price of oil is about 50% below the peak, maybe 40% below the peak in 2008. There's a reason for that because the U.S. back in 2008 was a net importer, one of the largest in the world, and we had a real estate crisis. Now, the world's largest importer is China, and they're having a real estate crisis. But the key thing about oil was it's on the back of that major demand shock, and now we're getting supply to kick in. And the rule in commodities, I'll leave you with this, is a higher price cure should kick in. Right now we have the war and there's fears of how that will happen and we'll have a cutoff of Russian supply. But Russian supply is probably going to go directly to China. And then I don't think there'll be a major disruption in supply in the planet. But key thing to think about what's happening right now is this is a major shock to inflation. It's a major shock to the Fed, for consumers, and it's basically a repeat of what it did in 2008. So I'm worried that this is going to revert lower, and that's what crude oil has been doing since the peak in 2008. I'll end with this. 3 times since 2008, it's dropped 80%. So that's what investors have to be worried about, and that would be more of a lower tide for everything.
Okay, you mentioned the North American producers, which is an interesting component here because OPEC seems like it's going to probably just do its own thing, maintain status quo. But what could happen over here in North America now that there's that opportunity, that margin that, if you're a shale producer, you're looking at $100 oil that you could spool up real quick and start pumping again?
I focus on North America, Joel, because that North America supply has been the major paradigm pressure shift in crude oil since the peak in 2008. Back then, North America was a net importer of about 10 million barrels of liquid fuels a day. As of this year, Department of Energy estimates show North America will probably have a surplus of about 14% of production of liquid fuels versus consumption. Now, I say liquid fuels because I'm from a farm background. And in this country, 12% of our unleaded gas comes from ethanol. And that biofuel stuff is kicking in. So, and I have to include Canada. But that's been the paradigm shift, that's pressured oil. That's what's changed from just a decade ago. And what does that mean for the future? That supply is not gone forever. It's just coming back. It's revisiting. It's resetting. The key thing is that peak has been in consumption. I just remember being in the business when I met Eric. It was all about peak crude oil supply. And it turned out to be peak consumption in North America. So U.S. total liquid fuel consumption in the U.S. peaked around 24 million barrels in 2018. Maybe we get to 23 million barrels a day. But the most significant retooling ever in the history of automotive manufacturers is toward EVs. I own an EV, and that is probably peaked forever, and it's going to head lower. And also versus GDP, it's insignificant. Now, the demand side is on China, but what's China facing? Major property crisis like the U.S. had. Now, if the world hits a recession, all that demand pull for China, and of course, is going to be a problem. Of course, just a fact of China is 20% of the automobile sales last year were EVs. First time ever. Where's that going?
Well, I would add that to make EVs, you need fossil fuels. I mean, there's a lot of fossil fuel behind the scenes of clean energy. But let's move to oil. You mentioned something in your first answer, which was the curve. And just to deconstruct this, I have two categories of commodity ETFs, those that are physically backed, like gold, where it really does track the price very well. But then ones that you can't store, like oil, natural gas, corn, they are different than the price because they own futures and they have to constantly roll them from one month to the next as the one becomes closer to expiry because no one wants to get oil delivered to their house. So can you explain to me, if we have USO or an oil ETF like that, what the annual roll costs look like right now versus what it looked like before, and what should investors be looking for when it comes to those roll costs? Or is it just worth it?
So the key thing there, Eric, is it's probably question is, does it get much better for commodity and energy investors right now because of backwardation? What backwardation means, you have to roll that future, and every time you roll it periodically, you roll to a lower price. The front end is bid, the back isn't. Why is the front end bid? Because typically what happens in you have a short-term issue with excess demand and slack supply, and then it's always expected to work its way out. It does. It's a higher price cure. The question is, how much better does it get? So right now, crude oil WTI is 15% in backwardation on a one-year basis. I always look at the annual. Most of the futures positions roll each contract. It depends on how they work. But this is a key thing I want to point out. You mentioned natural gas. You got to point on natural gas. It's the world's worst commodity investment in history of mankind, probably because if you look at the price right now, it's $4 to $5. That's the same price as 20 years ago. Yet it's the most expensive to store and always costs a fortune. And it's the key thing to remember about investing in commodities. When you invest in commodities, sometimes it's better to be more tactical. And if you're thinking longer term, buy and hold, stick with the metals. Gold, you mentioned precious metals because it'll hold the physical. You don't have to roll as much. But the way I look at nowadays, you cannot be invested in any commodities, most notably gold, without having some Bitcoin in that space, because it's a fact that Bitcoin is taking flows from gold and investment portfolios. So looking forward to what's the actual roll yield, it really is dependent. Typically, it costs on average 5 to 7% annualized to hold crude oil in a normal contango environment. Right now, you're probably making that in positive returns, in addition to the spot price. That's just the roll.
Okay, so we just went over oil, a little bit of natural gas. I would put all of those as big chunks of what's called broad commodity ETFs.
Yeah.
And the biggest one on the market right now that's taking in the most flows, and it's up 14% this year, which is one of the best performers of the year, is PDBC. So this is going to hold a whole bunch of commodity futures. You talked about tactical, and I know that's what you do. You write for people who are trading. But what about a long-term investor? Is this the kind of fund that is better to hold long-term, or should you never hold anything that holds commodity futures long-term?
Well, the lessons of commodities is more the latter, unfortunately. Just look at performance. PDBC from 2015 was around 24 or so. Right now it's 16. The problem is because there's a negative roll in commodities. It's not like equities. You can buy them, put them away, and they're done. You earn coupons. You have buybacks. You don't have to worry about it. In this type of product, there's always have to roll that futures. And the rule of commodities is normal contango. You're always in the long term going to have to pay some form of cost of storage. Natural gas is the most expensive to store commodity. Gold is the cheapest to store. And Bitcoin is actually the cheapest now. So that's why I wrote that in there. So that's going to come out through the futures roll. Now, there's periods when you have, like now, you get some great performance. And it's just a question of how long that lasts. But the bottom line is always remember is the cure for higher prices and commodities is higher prices. So why is the price of crude oil right now the same price as 2008? Wheat, the same price as 2008. Corn, the same price. And then let's look at even copper. It's the same price as 2011. That's a problem. It has been a problem. You mentioned the performance the last 10 years. But looking forward, when prices go up, I mentioned there's so much profits in the space that supply will come back. That's the difference with holding equities or commodity-based equities, which I understand a lot of institutional investors like to focus on if they want that commodity exposure, because you don't have that always working against that contango work, in the long term working against you.
So you mentioned some specific areas there, the wheat, the copper, corn. What other ETFs do you watch? And from a an investor standpoint, if we're back to a certain level and we have a potential for this to be an area where we could see increased flows, which ETFs are you watching?
Usually watch I don't watch commodity ETFs particularly much anymore. Having been there, done that, I managed many of them at S&P because I know what happens with those over time. They're melting ice cubes. It's just the fact of commodities, except for the metals. The key ones I watch are GLD and GBTC. And Eric knows which that is because I think what's going to happen is GBTC will convert to a ETF. It's going to take out that discount, and it'll probably end up being one of the best ways to get exposure to Bitcoin, which is becoming the global digital reserve asset and the world going that way.
Okay, Mike, whoa, okay. So you just went over a lot quickly. I just want to, can we just put Bitcoin aside for a minute? We'll get there. When we look at gold in particular, it seems as though, I guess we can bring Bitcoin right back in. GBTC is a trust which doesn't have new share creation, so it's trading at a discount. That's a really unique trade that people are looking at. Let's put that aside. Let's look at gold and Bitcoin. It seems as though gold is a better store of value right now. It doesn't move around as much. Bitcoin seems to be trading like a high beta tech stock. So isn't the bid on gold right now make more sense if you're worried about inflation and the world, having geopolitical situations? It just seems like gold is actually showing why it's more true zero correlation. It's a better diversifier / hedge, whereas Bitcoin is really more like a shiny object.
I have to push back on that a little bit. Gold has been a horrible performer the last couple of years, despite the highest inflation in 40 years, and Bitcoin has done very well. Ethereum has done a lot better. So I look at it this way. I can't speak about gold anymore without Bitcoin in the same bucket because the world is going digital and Bitcoin is a digital reserve asset. And I see it and sense it every day that the old guard that held and allocated to gold all know they have to have some Bitcoin in that bucket. The key thing about gold is I fully expect it's going to perform a lot better in a deflationary environment. And it has. And that is a good indication for that would be when the long bond yield starts dropping, which I expect. Long bond yield right now, it's peaked last year at 2.5%, and now it's like 2.15%. That's a recessionary trade. And gold's had some major competition for a stock market. Last 3 years in a row, stock market's up, S&P 500 average at 25%. Who needs gold in that environment? That to me is what should be changing. But the key fact is, Eric, and that's why when I mentioned earlier, ETFs I watch, got to watch something that tracks Bitcoin. Because those two belong together, and I say gold is naked without Bitcoin in the same bucket. That's just the facts of where things are going and have been going in the last few years.
So now that Ukraine and this war is underway, a lot of interest in what Bitcoin will do. What's your take?
I think it's showing divergent strength versus the stock market. It certainly is. Bitcoin is down a few percent. But it basically trades at 3 to 4x the volatility, meaning the risk, 260-day volatility is that much higher. So Bitcoin at this stage versus the stock market should be down a lot more. So what I think is happening is Bitcoin is transitioning from a risk-on asset to a risk-off asset. And what's happened, and this war might have just set that tone, kick the inflection point and been the trigger point. People in Ukraine and Russia who can't get a penny from ATMs, have access to crypto dollars via their phones and cryptocurrencies, and Bitcoin is the biggest one. So to me, this is the transition. And the key fact is, ask a millennial about gold. What do they say? Yeah, sorry, I'm going for Bitcoin. The world is going that way. And I look at it as, why take the risk of not being allocated to one of the best performing assets in the world that's going digital? And like I said, I'm bullish gold. I think at some point what's going to happen is gold's just going to pop above $2,000 an ounce and stay there. But I fully expect Bitcoin to outperform it. The key thing is, how will we perform if and when we get the next down leg in the stock market, which I expect. Bitcoin is still risk asset. It'll probably gravitate lower, but it's been holding very good support around 30. And I think I'll end with this. I think it's just a matter of time that this global digital collateral goes to 100 grand. It's just a matter of time. That's just based on supply, demand, and increasing adoption.
Let me ask you this question, which is something that I've been seeing debated on Twitter over the past couple of days, and it's a really good one, which is this idea of crypto trying to have it both ways. And this question really strikes at the core of that. Should crypto exchanges comply and do what the U.S. government wants it to do in terms of freezing Russian accounts? Or should it say, no, Biden administration, that's not what we are. We are DeFi, And that's the whole point, is that we're not run by the governments. What should they do?
They have to. This is a war. And in war, the government can make them do it, and they should be smart enough to say, okay, we're going to help the cause here, because we have a very oppressive dictator taking over and taking over a free country. That's got to stop right away, or it won't stop. And so any other financial institution has to do. Why shouldn't crypto exchanges to be different? Also, license will be revoked. That's just a fact of war. Get used to it, and get used to paying taxes when you make money. That's life. The thing is, this is a revolution in digital assets. Now, anybody in those, they can run their own nodes. You don't have to go through an exchange to do things. And they can figure it out away from these exchanges. But when you have KYC and AML rules, and to be licensed in the U.S., you got to do what the government tells you. It's the facts. But that's what's going to happen this year. I fully expect we're going to have more clarified regulation from the U.S. Eventually, Alec, I know, Eric, this is your space. To me, it's just a matter of time we get properly tracking physical ETFs that track an index of cryptos, just catching up to Europe and Canada. You know what's happening. Funds are leaving the world. But Bitcoin is becoming global digital reserve asset, and this war is defining that. But the exchanges have to comply to what's happening. I expect a year from now, we're going to see Russia completely isolated on a global economic stage. And if we don't do that, we are risking this tyranny spreading. We have to. So it's just like ESG investing. When your grandmother in Ohio, who is a former teacher, finds out that some of her pension fund money is invested in Russia, there's going to be an uproar. It's got to be complete pull the plug.
Yeah, I agree. Bitcoin is here to stay. Crypto is here to stay. I just think there's a lot of, the performance and the use cases are definitely going to be debatable for a while, in my opinion. But let's just take a big step back and just talk to me about. I just talked at the beginning of the podcast. We talked about commodity ETFs up a good amount over the past year, as because inflation fears are here. Is now a good time to add to that? What practically should people do with a portfolio in terms of commodities? Should they use like a broad commodity and then add it with a little GLD and crypto? And I know we can't give investment advice, but what generally should people think about in terms of how to put this into a portfolio?
Think about commodities as a hedge. It's worked great as a hedge, but if you want to just be overweight or underweight, the rule of commodities in most markets, you should be buying when they're crying and selling when they're yelling. And the market is extremely high levels, and don't ever underestimate the higher price cure. So I fully expect crude oil can easily drop 50, 60, 70% this year. And that's just what it's done 3 times since 2008. So be prepared for that. And I fully expect, if you are worried about inflation, which is what you should have been worried about a year ago. I mean, this is not the time to worry about inflation. It's time to worry about the base effect and Fed tightening and most assets going back down, which has always happened, and it's going to happen, I think, particularly because we have a risk of this recession. But that's the key thing. Now, and overweighting commodities here, I just learned this lesson, been in the business for a long time. You just never want to get too bullish commodities when producers can make so much money at such good levels. And, that's the old days when the U.S. was a net importer of liquid fuels, and now the U.S. is a net exporter. And this is, the world's changed. And I view commodities as naked if there's not some digital assets in that space, because that's what's changing. The adoption of Bitcoin and Ethereum is happening rapidly. And I'll leave you with this. The most widely traded cryptos on the planet are digital crypto dollars. People call them stable coins. But they're really crypto dollars, because the vast majority track the dollar. They're all based on Ethereum tokens. It's just a better way to do business, Eric, just like you did learn in ETFs. It's just a better way to invest. Crypto dollars are a better way to do business. And instant settlement, 24/7 trading costs you nothing. You're an interest. What more do you need to know? And it's decentralized. You don't need a bank in between. So that's going to be regulated, but they're based on Ethereum tokens. That's part of what Ethereum is doing. It's revolutionizing the space. And then there's Bitcoin, the digital version of gold, and the world going digital.
You mentioned the potential for recession a couple times. How do you see that playing out? And is the commodity market, and does that provide indicators for what may transpire?
Oh, sure. Right now, spiking energy, the most severe energy crisis in Europe in my lifetime, is a very good sign of what will happen to consumer spending. It's going to get crushed. I mean, just simple facts of inflation. And this is not profound. This is almost exactly what happened in 2008, but it's going to be worse, I think, this time, because it's global. It's being centered in Europe and China, and U.S. should come out very well. So spiking energy is really bad. So let's look at the fact that the S&P 500 is peak to trough has dropped 15% this year, yet the Fed funds are still priced for 6 tightenings, 25 basis points in the next year. I used a 1-year measure. The last time we had a 20% correction in the stock market was 2018. In September of 2018, market was priced for 4 hikes, high tightens in the next year. By the time we got December, they're talking about easing. We're still priced for hikes. So the headwinds are increasing for asset revisions. We have this war, which I think is a significant trigger for negative consumer sentiment. And I'll end on this. In the beginning of the year, versus their 60-month moving average, the S&P 500 Bloomberg Commodity Index were both about 50% above those levels. That's never happened in the last 60 years, where they're both that stretched. So simple mean reversion is what I'm worried, and now we have pretty significant triggers for that.
All right, stuff to watch. Mike, one ETF we haven't talked about is wheat, WEAT. Ukraine being such a big producer of wheat. Obviously, the war is going to jeopardize that production. What do you think would happen to that ETF?
Buy low, sell high, the higher price cure. There's going to be massive supply coming in the U.S. Wheat tracks the U.S. wheat future. It has to roll in contango historically. Wheat's expensive to store. If you're going to invest in anything commodities in that space, look at soybeans. It's one of the best roll yields of all commodities, soy. And corn will crush you maybe 6-7% a year cost just to hold it. And wheat is great, but the time to buy wheat was 2 years ago. And if you've been long, you're supposed to be lightening up. I would not suggest overweighting here. And this is the problem you have to be careful about. People chasing markets, and that's the last thing you ever want to do in commodities. If you miss it, you miss it. And if you want to get in that space, look at soybeans, because they're not going to cost you. Historically, they're easy to store. They typically don't have that contango to roll in. Wheat, you have contango to roll in. It typically costs you 6% annually just to hold it.
Last question for you. What is your favorite ETF ticker?
GBTC.
I probably could have guessed that.
Come on. I was hoping.
Eric, I thought you'd love that.
Listen, this is why I think Mike's gone full Bitcoin, because the old Mike, he would have picked GLTR, glitter, which is this cool basket of the physically backed gold, palladium, platinum, and silver. Yeah. We kind of like this ETF on the team. We feel like it's a kind of a cool, like, diversified metals ETF that has no weird roll cost in it. And that was from Mike's old company. But the fact that he didn't pick it shows Mike he's gone Bitcoin. He's gone, Joel.
I got to give you 2 reasons why. It was 5 years, buy and hold, accumulate, never trade. 5 years, buy and hold, accumulate, never trade. I think the upside is many X's in GBTC, and glitter might be a couple. But to me, and your risk obviously is appropriate, and you might lose more too. But I see the upside is, like I said, it's unlikely. It's like, say, many X's, and for the trend to continue. GBTC, yeah, I love it. I've exposed it in the past. I like it, but it's already had a pretty good run, and I think those together paired would be good too.
Also, but again, when you're looking at your portfolio, wouldn't glitter or gold GLD be better to put in the commodities section, and GBTC or Bitcoin you should replace maybe some tech stocks with that?
Well, you could do that, but we're getting that divergence now, Eric. I would say Ethereum's more associated with tech stocks, maybe a Bloomberg Galaxy crypto index or an index, an ETF. Eventually, we're going to be talking about someday that tracks an index of cryptos. But Bitcoin has become a global digital collateral. So I think what's transitioning this year, and it's already showing up in the tape, is Bitcoin's transition again from that risk on to a risk off asset. And we're seeing that I see bids coming in below on all dips, and it's going institutional. Now, here's a good fact about it. It's still less than 1% of most institutional portfolios. And I think most fiduciaries realize their greater risk is not being allocated to this space. They might as well have some rather than being able to tell their grandkids, why did you miss the best performing asset in history versus you lose 1-2%? It's not as important. I'm sensing that everywhere.
Okay, Mike, thanks so much.
Thanks for having me.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, and wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Francesca Levy is the head of Bloomberg Podcast. Bye.